Ladies and gentlemen, welcome to another video brought to you by Trader24. For more financial analysis, subscribe to our channel. 3M stock has found itself in a very difficult position as the significant loss of its investor base has led the price on the New York Stock Exchange to see a 21% monthly loss, which has led at a 9-year low reached several months ago in the $114 area. The level represents the last point from which supportive buying may come out in an attempt to mitigate the distortion that has been created between the stock's performance and the company's financial condition. The long-term picture for the stock remains weak as the combined narrative of investors' inability to break above the iconic $200 and the company's exposure to existing inflationary pressures, at least on a discounted basis, have given the once stalwart stock a downward bias, dropping it below the sub-$70 billion bracket it hasn't been in since 2013. The gap to the bottom of the trend is wide as $70 appears threatening, with the stock already recording its fourth consecutive down week, even taking back all of July's gains. And indeed, the 5-month battle on the outskirts of $155 gives the impression that as long as the stock moves below there, it will hardly find enough takers. The current levels of $170 can be characterized as a point from which some sort of bullish reaction against the existing negative momentum would be warranted on the basis of the price approaching the lower boundary of the formation. The reaction might lead towards $123 in the first instance, with the whole sentiment being pessimistic, while any loss of $117 would constitute a re-entry of the stock into an oversold zone, with the next stop being the psychologically important $100 area. Despite the particularly difficult situation for most of the Wall Street listed companies, 3M's picture does not point to any major problems. Certainly, the decline in turnover for the second consecutive quarter is an issue, but the low percentage losses, minus 0.25% and minus 2.77%, partially offset the situation. The clouds are gathering on the company's profitability, which saw a 95% dip in Q2 2022, which will obviously disappoint dividend lovers, which in this case is traditionally generous, with a current yield of 4.89% annualized. The company's operating cash flows remain stable around $1.13 billion, with an operating profit margin of 6.27% and a return on equity of 29.44%.